Hey, Jerry, are you there?
I'm here. I'm here. I'm ready to go. Rock and roll.
All right, where's Alan?
Alan? Who needs Alan?
Hey, Jerry, can I go to Notre Dame? Is there like a category for puppets?
Uh, yeah, we have a stiff. We have something for stiffs.
Excellent. I hope that there's mixers because I'd like to meet another puppet so I can file jointly married.
All right.
All right, Gassman will be here very soon. Welcome to Using and Running Numbers in Estate Planning. I'm Alan Gassman. Jerry Hash, the amazing Professor Jerry Hash, is with us, but by uh, vocal only, not video. So you'll have to see more of me. This is a 1-hour presentation. If you've come in through CPA Academy, you will get 1 hour of credit as a CPA or enrolled agent. If you came in through our website, if you are a Florida lawyer, you will get 1 hour of Florida bar time. More importantly, this will seem like 2 hours, but it will be 1 hour. And Jerry, if you don't mind, once we are at 60 minutes at noon, would you mind hanging around an extra 5 or 10 minutes, maybe even longer, to talk specifically about what you're going to do at the Notre Dame Tax Institute this year?
Sure.
Okay, great. All right, so if you're a new attendee, then we encourage you to do something else. These programs are not very good. But if you have questions, you can click on the inverted question thing on your panel there, and you can type in your question, and we will attempt to answer all questions. In about 3 to 4 hours, whether you want it or not, you will get an email. You can click on that email, and it will give you this video. You can forward that to friends or enemies. If you are watching this as a video replay or on YouTube, please put it on pause and go to the setting button there and then click on 1080p HD. Now, that's not because Professor Hash is a PhD. It is because it will give you a much better picture. Jerry's going to join me again, at least on September 2nd for private annuity and self-canceling installment notes, and hopefully for other programs if you encourage him. Today, we're going to talk about Estate View software. You can use it free of charge until we go commercial, which will be weeks, if not months. Go to the website by going to estateview.link. Tell it your email address is test@test.com. No capitalization, please. And then your password, secret password, don't tell anyone anywhere about this, is test, T-E-S-T. Next week, Gentry Burns and Katie Pimble are going to talk about what it takes to operate, set up, and help people as a trust company. And they are the first Florida female-only owned trust company. So that will be very, very educational. Please bring all of your friends and neighbors for Jerry to join me on September 2nd for private annuities and self-canceling installment notes, bringing us to the first polling question. The first polling question is, who is Jerry Hash? A, he explained the tax law to President Gerald Ford in give and take conversations. B, he is the director of the Notre Dame Tax and Estate Planning Institute that you don't want to miss. C, he's a member of the National Association of Estate Planning Hall of Fame. D, he was with the Office of Chief Counsel of the IRS during the Gerald Ford presidential administration. E, he is without a doubt the most popular estate tax professor who has ever lived. And E, all of the above. So go ahead and pick one of those, or all of them, or E, all of the above, and we will get on to the next section. There is Jerry's information. Jerry, anything you want to add to what I've said about you?
No, just skip it next time.
All right, exactly. I do have the Notre Dame information here. Set your calendars for September 20 through 22nd. And as I said, at noon, Jerry will be going over this, and we'll be having a give or take discussion on some of these topics and why they are important. So Jerry, we're already on page 25 in 5 minutes. That's pretty good. Tell us what you tell your students and what you tell your clients about
Okay.
the estate tax.
All right. Uh, as every estate planner knows, there's 4 separate factors that contribute to the ability to shift value to irrevocable trusts without paying estate or gift taxes, and have the assets in the irrevocable trust not exposed to the estate taxes. And everybody kind of talks about these separately. The easiest one is you want to discount the value of your assets, so you put it into a family limited partnership. You get a limited partnership interest that has lack of marketability, lack of control, and you get a discount. Okay? And that seems to be the hot button issue because everybody talks about all these valuation cases. The other factors are actually more important than the discount. And the second factor is what we call financial leverage. If senior sells an asset, it's an income producing asset that's producing, say senior sells an asset worth $1 million to a grant or a trust and takes back a 4% promissory note. So all that the trust has to do on $1 million at 4% interest is pay $40,000. And that income producing asset earns $60,000. So the trust has this profit, and we call that financial leverage. So that means every year $20,000 of income in excess of the interest cost is in the trust. The other factor is if that $1 million asset appreciates in value, the trust owns it, not the individual. All the individual has is a promissory note. So we call that a freeze. And then the fourth factor, which is the most important factor, is in that $1 million example where the trust has $60,000 of income and only pays $40,000 of interest, so the trust nets $20,000. But the grantor has to report and pay income taxes on $60,000. And we call that the burn. And the key is all 4 of these factors work in conjunction. And when you try to explain all these 4 factors, it can become rather complex. And the key is, as the assets in the trust build up over a long period of time, we have the compounding of the annual spreads. And so the most important point is you start to talk about all these factors and you start to try to explain them, and it can be overwhelming. So the key is really, how can you explain how everything works together and the compounding over a long period of time in an understandable manner? And the easiest way to do it is to use illustrative financial examples. And what we have done, what Alan has done, is develop a state view. It's still in the developer's version, a lot of kinks to work out, which is designed to illustrate how these techniques work and how everything kicks in an understandable manner. Because then, when you have all the numbers in front of you, you can custom design it to meet the particular needs of your client. In other words, all these planning techniques, how do you work with them and design a structure that maximizes the benefits while also being cognizant of the individual's needs? And that's really what we're going to do today. Very simple. It's how to communicate in an understandable manner all these complex techniques and all the factors in an understandable manner. Okay?
So Jerry, let me just ask you a couple questions in this realm. I like, and I completely agree with you that the discount on the sale or transfer of an asset is a small part of the overall tax savings. By the same token, I guess you would say that the valuation of a particular asset is not important as important in the long run as the ability to fix an interest rate as to, and as the ability to pay the tax on behalf of a trust that you've transferred to. A lot of clients are interested in doing this planning with real estate, commercial or residential real estate, but they're afraid that we may be in a bubble. And you know, you've been through a lot more, you've been through a few more recessions than I have, and you're a mathematician. What are you telling clients right now when they say, well, I'd like to do this technique with my commercial shopping center, but what if we're in a bubble?
Well, the key is, this is why you have to do a financial analysis. And what you have to do is basically, maybe you're not going to commit as much as possible to the plan, because what we're talking about is right now, if you have a commercial rental office building, your occupancy rate is maybe 60 to 70%. Okay, and so therefore, one of the most important things is if you sell a building that's 100% occupied, and you have this rental stream, and you basically sell it for a promissory note or a grat where you got to make the payments, you could be in a situation where all of a sudden the rentals go down and you can't meet the payments on the installment sale that the trust issued. So essentially, what we try to do is say we want coverage. And given that you have a building, say, worth, after discounts, $40 million, maybe, just maybe, you should gift a third of the building to the trust and sell 2/3. That way, if the rents go down, the coverage by the gifted portion can make up the shortfall. And of course, that is very important, because when everybody does their financial projections, they assume the most optimistic financial projections, not understanding that commercial real estate can likely go down. Now, the nice thing about commercial real estate today, it is extremely depressed. So these values today are really low. But what you're talking about, Alan, is somebody sold their commercial real estate to a grantor trust 5 years ago, before COVID hit, with 100% occupancy, and they basically funded the trust with a minimal amount. So the key is, when you design your structures, make sure that there is always coverage, reserves that the trust has to take care of the potential shortfalls that can occur in the future.
Yeah, you know, Jerry, I think another idea is that, you know, if your client has a $10 million SLAT, a $10 million spousal limited access trust, or a $10 million irrevocable trust, it's up and running, and you want to sell something worth $5 million to that trust for a $5 million note, and you're afraid that asset may go down in value, I think it's better just to put $500,000 in a new trust, sell the asset for $5 million to the new trust for a $5 million note, and then if the asset goes up in value, if the asset goes down in value, then the trust is just busted. The note can't be paid, the client gets the property back, the trust has no assets in it, and then the client can go sell it again to the bigger trust.
In other words, it's like the 2-year rolling grats. It's going to go bankrupt. So what you're saying is, if you got 5 or 6 pieces of commercial real estate, don't put them all in one trust. Maybe do 5 separate trusts. Very good.
Right, and they can all merge together. Now, the second thing, Jerry, with all of your experience, is that these applicable federal rates that we can use for these promissory notes are going up. A couple years ago, they were under 2%. So I could sell $10 million worth of assets for a note at 1.98%, and I wouldn't have to receive very big payments. Well, the September rate was just issued for a note over 9 years it's going to be 4.15%. So here I am in August telling clients, since you can use the lower of this month's rate or the last 2 months, you could do a 3.75% note. But if you don't finish it in August, then you're going to have to be at 3.94%. Then it seems to be going up, up, up. And some clients, Jerry, say, is it still worth doing 4%? And what's your response to that?
Well, remember that if I have a $10 million asset that's producing, say, $40,000 a year or $30,000 of income, that's a 3% rate of return. But remember, I discounted that asset to maybe, say, 7 million or whatever. So, so all of a sudden, it's 30,000 on 7 million as the interest rate. So what you have to do is look at the actual cash flow, because remember, the actual cash flow, the rate of return can be on the property can be increased by just discounting it. So that's how that's the factor you take into account. But the main point is you always want a little bit of coverage because interest rates are volatile, and then just assume that what you should do is assume that you're going to have coverage, say, for 5% rate of return. And that's why you always want coverage.
Right. I remember the first installment sales I did, the applicable federal rate was 6.25%, and those all did really well. So 4.15% still looks inexpensive. So Jerry, here's trivia for you. Why do you have to use the midterm? I'm sorry, why do you have to use the biannual applicable federal rate for a note that only pays interest annually? Do you recall?
Yeah, because when Congress first enacted the OID rules in 1984, they did everything based on semi-annual rates, and what happened is it's all based on semi-annual. So if you have an annual rate, it has to be adjusted.
Okay. Super. All right. I'm going to, the next thing I want to talk about, Jerry, is the time value of money. When I sit with a client and they have a $20 million net worth and they say, well, we're well below 26 million, we don't have anything to worry about. And I say, yeah, but if your investments continue to grow at 7 or 8% a year, which is pretty much an average over the last 65 years for a well-rounded stock and bond portfolio, you'll be at $40 million next year. So Jerry, do you use any rules of thumb, or what? How do you explain this in conversation to a client?
I basically say to the client, rather simple. You got $25 million of assets, and you have two 13 million exemptions. Okay, so you have to say to the client, I don't really need it. So the first thing you can say is, guess what? The exemptions will go back to half of that amount in 2026. And do you want to die before 2026 to take advantage of the 12 million exemptions? And they say, hell no. So first thing you say is you have to do planning based on the assumption the exemptions in 3 years from now will be half of what they are today. The other thing is very simple, is if they feel comfortable having 20 million net worth, you do essentially a freeze transaction where you freeze their net worth. They could basically sell their $20 million for a $20 million note, and they're always going to have 20 million. And if the property goes up in value, the trust has the property because it purchased it, and all you have is the note. But the key is you can actually show this example that Alan has here that basically said, because someone with $25 million cannot afford to make two $12 million taxable gifts. Maybe they can afford to, in other words, I don't think somebody with $20 million should make taxable gifts of more than $5 or $6 million each. Because, right?
Well, you might make the gift. You might make the gift to an asset protection trust that you could be added back to if your friends, the trust protectors, decide that you should be added back and your net worth goes way down. But I do agree. There are times where people do give too much, or they give in a way that they've completely lost the asset. But for the attendees, I have two spreadsheets I'm glad to share with you. And Josh, if you could put these into the place where everybody can download them. This first one is for a single individual. And for example, they start at $6 million in net worth. It's growing at 7%. If I want it to grow at a faster rate, I can just click on this and it goes up or down. And then initial net worth, 6 million. And I can just click up and down to move it. And then don't forget, they're saving money every year. You can't just use a rate of return, because this person, maybe they're saving $100,000 a year. And look how quickly it goes from 7 million to 10 million to 15 million. And then the number of years they're going to save. Now, you can also use this spreadsheet with your friends and for yourself. Right now, my net worth 7 million. If Marcia and I can save 100,000 a year, this is what we'll be worth in 20 years. If we can only save 80,000 a year or 90,000 a year, here's what happens. And then in yellow, you see what the estate tax would be with no planning if they die after the exemption goes down to half in 2026. And you can just type in the numbers, but what my staff calls Allen proofing. They know I can't use Excel very well, so they actually give me these buttons. And if you want to know how to install these buttons on your Excel spreadsheets, let us know. We'll be glad to share it. And then I have a married person Excel spreadsheet as well. So, these people, for example, starting at a smaller net worth, 10 million, they hit 26 million pretty quickly, and a lot of estate tax. Okay, so before we go into further territory here, I want to get our second polling question done. And polling question number 2, actually, I'll go to this polling question. Which of the following is true about the Notre Dame Tax and Estate Planning Institute? A, it will be held September 20 through September 22nd, South Bend, Indiana, followed by a football game. B, you may register online. C, it's $860 for a lot of sessions. It's basically 5 days worth of sessions, the way Jerry does it. A lot of laymen, a lot of my wealthy clients have attended and really enjoyed it. D, if you can't attend, you can purchase all the materials and audio recordings for under $1,000. E, you would get 17 continuing education hours, including 2 hours of ethics, 1 hour of technology. F, all of the above. Josh, has everybody answered?
Well, Alan, what's interesting about Notre Dame, it's really a 2-day program, 8 hours a day. So that's like 16 sessions. But we actually have like 32 sessions because we have concurrent sessions. The reason is you might not be interested in listening to every single session. So you can, as you can see, we have concurrent sessions that actually are opposite each other. So there might be a session that you're not interested in, and there's a session that you're interested in, so you have a choice. And if there are, and the nice thing about it is you can have access to the recordings for all the sessions you miss. Some people like the fact that they actually have access to all the sessions, even the ones that they can't attend because they're concurrent. And if you wanted to attend, you can't attend remotely, but you can get all the materials and all the recordings for a fixed price, which will be mailed. We can't send you the recordings until after the program is over, but the nice thing about it is you can then listen to all the sessions and the recordings to fit your own schedule over an indefinite period of time.
Yeah, so we'll talk more about this at noon. So, Jerry, I'm going to go ahead and show the Estate View software primary module here. And what I'm going to start off with a single individual, not married. What kind of net worth would you like this person to have?
Well, let's have a single person with a net worth of say $20 million.
Okay, and how much of that is business property and how much of that is a residence?
Well, let's forget the residence.
Okay.
And let's say they have $20 million of investment assets. Okay.
Okay.
That's producing a nice conservative rate of return. Okay.
All right.
Okay.
So let me get to 20 million here. For some reason, I'm sorry, I put in 2 million. That's a mistake. One thing Estate View does not handle is operator errors. Those are still going to happen. Okay, so then I'll put the residence to 0. All right. And then how long would you like for this person to live? I'm showing 10 years. In 10 years, 20 million would become 48 million at the rate of growth I'm showing.
Well, let me ask you a question. How old are they?
Oh, let me see how old he or she is. This is Joan, and
19.
she's 71. She's 71 years old. You can see her life expectancy is to 2037. She has a 16-year life.
Someone age 71 has a life expectancy of about 15 years. The problem is the life expectancy for someone age 71, 15 years, is based on everybody who's age 71. And all that means is there's a 50% probability that everybody age 71, 50% of them, when they reach their life expectancy age, will still be alive. So, and remember, our individuals say, so I would always say someone age 71, you say, I would always carry the projections out 20 years to age 90 at a minimum. Okay.
Okay, so assuming a 7.5% rate of return, and 0.4% investment fees, 1.9% of portfolio annual taxes, and pension and other income that exceeds expenses by 125,000 a year. In 20 years, this person has $53,910,000. That's quite a lot. Now, what would you recommend for this person? Would you first talk about how much they would gift to children and grandchildren each year?
No, the first thing I would ask them is, with your $20 million investment portfolio, okay, and whatever you have in Social Security and whatever you have in your pension, remember, Social Security you can't do estate planning with, all right? And your pension plan is yours. It's designed for your retirement, and you really can't transfer your pension plan to your children while you're living. You shouldn't. So you have to ask them, look at all their sources of income, and also say, how much do you think you're going to be spending on your personal consumption and your income taxes every year? And also increase it by a rate of inflation, because you always want them to have access to the money they need for their living expenses and income taxes for the rest of their life. And if that means that means they're going to have to retain certain assets. because you can't just dispose of it all. And of course, they're single, so they don't have a spouse. So we're not going to talk about, trust for the benefit of your spouse right now.
Right, right. So what's the next thing that you would show this person?
I would basically, talk about the four factors that contribute to wealth. The discount, the financial leverage, the freeze, and the grant or trust burn, and basically say we can illustrate that all by making with $20 million, I would only make a gift in trust of say $6 million max. Why? Because they're going to survive more to beyond 2025 when the exemptions are cut in half. So, because what we can show you is we can design a structure that will give you income for the rest of your life and basically shift as much wealth possible without having to maximize your taxable gifts.
Okay, so you would just have the person make a $6 million gift?
Yeah.
Okay, let's see how that works. So I'll take a first year gift to 6 million. I'll click on installment sale. Wow, that makes a big difference. Couldn't be that good, could it? Yeah. So it brings her initial net worth down to 14 million, 6 million in the installment trust. And then because she pays all of the income tax on that installment sale note, the installment sale trust is worth 35 million when she dies. She's only worth 17 million, and the exemption is 19 million by that time. That's really surprising, isn't it?
Yeah. The point is as the income producing assets and the grantor trust build up because of the financial leverage, the freeze, and then you have to pay the income taxes. You've got to keep enough money in reserve in order to make sure that the grantor trust doesn't deplete all your assets while you're still alive.
Now, yeah, go ahead.
Yeah. So basically, what I'm showing you here is they have been able to retain $16 million of assets for the financial security of knowing they can evade principal and income in their 90s without having to worry about where they're going to get the money and having no estate tax.
That's amazing. Very.
And it's easy to visualize it with numbers here.
Yeah. Now, if the estate exemption goes down to half in 2026, I'll click here. Now she does have some estate tax if the exemption comes down, and it will be a $4,500,000 tax. So do you think she should consider an installment sale now in case that would happen?
Well, the point is we know we want to eliminate $4.5 million, but we also want to remember we want her to keep enough so that she'll always have the income. So now you can do an installment sale, because when you do an installment sale, you kind of take advantage of all the factors, but retain some income.
Right. Okay, so what sort of discount would you use for that? Would you want to use C25%?
Now here's the key: is all the litigation is almost always on valuation of the properties and the discounts. And the bottom line is the IRS usually, if it's done correctly, usually will. So the typical thing is you put your marketable securities into a family limited partnership, and the appraisers will come back with discounts in the 35 to 40% range. The IRS, when they look at these and they're all done correctly, will come back and say, we'll give you discounts of 15 to 25%. So the bottom line is the clients are selling you, I want to maximize and take advantage of everything. But at the same time, the clients are saying, I don't want to get audited. So if you basically use a lower discount rather than 35%, use 20 or 25%, the chances of the IRS auditing yours go down significantly. And because the discount is the least important factor, you can then fine-tune everything to make sure that you have a cash flow. In other words, by reducing the discount, my promissory note will have a greater principal amount with more interest as well.
Okay, so Jerry, what I did here is I had, instead of giving 6 million to the trust, I had her give $1,425,000 to the trust as a gift. Then I had her put 14,250,000 into an LLC, and I had her sell the 99% member interest in the LLC for a $10,687,000 note. So we've converted $14,250,000 worth of assets that were growing at about 6% after expenses into a $10,687,000 note at 3.75% interest. So without discounts, at the time we made that transfer, we reduced her stake by about $5 million right off the bat, because, as you said, the discount. Then the second element of that is she's only going to grow by 3.75% of 10,687,000 instead of growing at 6.5% of 15 million. And the third part is her estate, her remaining assets get smaller, because even though she's receiving about about 390,000 a year in interest on the note, she's paying the tax on behalf of that trust, and that gets her estate tax down to zero. And really, she's only given away $1.4 million instead of $6 million, and she's holding a $10 million note. If she decides next year she doesn't like this anymore, the trustee can pay back the note, and she hasn't made a big gift. But every year you have this ratable reduction in tax. And do I have that right?
Yeah. The point is that there's all sorts of factors, and when you have the ability to illustrate different assumptions, you can then custom design it to meet not only their tax saving needs, but their personal financial concerns as well.
Right. So, and all I had to do using the estate view, by the way, is, as you saw while Jerry was talking, I just dialed this. I kept clicking it until it got to zero estate tax. Now the question is, what if she dies before the 20th year? Is she estate tax proof the whole way? Well, I click timeline, and this shows me if she dies before that 20th year, there would still be some estate tax. So I'm going to advise her to do a larger installment sale, and as you can see, that estate tax, still comes down, but there's still some of it. So Jerry, before we go to the next module, I want to get the next polling question done for the CPAs. Let me find it here. Okay, if you'd like to be a beta tester for Estate View, A, no, I like beta fish, but I would not give them artificial respiration. B, no, I would rather have a babble fish, which is from the Doug Adams book, The Hitchhiker's Guide to the Galaxy. You put the babble fish in your ear and it translates for you. C, yes, it seems like it would be very helpful. D, yes, and I would like a beta fish as well. And E, all of the above. And if you do want to be an Estate View tester, as I said, you just go to estateview.link, tell it your email address is test@test.com, tell it your password is test, and you are in business. Josh, are we good to go to the next item? Okay, good to go. So Jerry, before I forget, I want to show you something I don't think you've seen yet. And that is the client may say, forget the installment sale. Don't really want all that complexity in my life. I'm at a $17 million estate tax. What if I want to give to charity? So I'm going to click here. I'm going to click on charity. And then I'm going to go down here and click on testamentary charity. And the answer is, instead of your children getting 56 million and Uncle Sam getting 17 million, you can do a testamentary charity to a foundation for your children. So again, instead of Uncle Sam getting 17, your children getting 56, Uncle Sam gets nothing, charity gets 43, and your family gets 30. So the client may say, well, I'm charitable, but I'm not that charitable. Let's go ahead and do half as much of an installment sale or a smaller installment sale, get the estate tax down to $1 million with 71 million going to my children, or let the excess go to charity, which gets 2,600,000, and the beneficiaries get 70 million. So again, you can adjust to that. And this is a great time to talk about charity when you show them that there's no estate tax if you do this. Jerry, any thoughts on that?
Yes, as a matter of fact. So what you're telling me is when you die, whatever is going to be the taxable estate, have a bequest to the charity, correct?
Right.
And
Absolutely.
So, and here's the key: is you basically want the income from that asset that is going to be left as a bequest to charity, correct?
That's right.
Okay. Now, if I have a bequest in my will to a charity, can I get any income tax deduction for it?
Only if you do it while you're living.
Oh, wait a minute. Why don't I take that income producing asset, whatever, what was the amount that you're going to give the charity? 8,534,000?
That's right.
In other words, you figured you're going to be left with $8,534,000 of assets that would be exposed to estate tax. But you need the income for the rest of your life. And if you do it as a bequest, there's no charitable income tax deduction. You put that $8,534,000 in a charitable remainder trust that pays you the income for the rest of your life. So you're getting the income from the property for the rest of your life. It goes to the charity, so there's no estate tax. But guess what? You get an income tax deduction for the present value of the amount that's going to the charity when you die. So you have the best of both worlds. You basically zeroed out your estate with a charitable bequest, or you reduce your estate with a charitable bequest. But you put it into a charitable remainder trust, retain the income from the property for the rest of your life because you need that income. That's why you have a bequest. So it's the practical equivalent, and you get an upfront income tax deduction that you would not get if you left it by a bequest. Very
Beautiful.
Good.
So Jerry, what about if they want to use a CLAT? Do you want to explain? I met with a client yesterday. I talked about a CLAT with him. Can you explain the CLAT so that he can watch this video and understand it?
Well, a charitable lead trust is the opposite. In a charitable remainder trust, you retain the right to the income, and when you die, whatever is left in the trust goes to charity. A charitable lead trust is just the opposite, the analog. You basically have you set up a trust. All the income for a period of time is payable to charity, and at the end of the charitable lead trust term, whatever's left in the trust passes to your children. Okay, and that is a pure estate planning technique because it basically takes advantage of all the factors, the discount, the financial leverage and the burn and the freeze. And it's a pure estate plan. But the nice thing about the charitable lead trust is you get a current income tax deduction for the present value of all future payments going to charity. And all you have to do is report the income. Because it's structured as a grant or trust, you report the income. So in other words, the charitable deduction isn't 100% benefit, because to get the charitable deduction, you have to report all the income that is going to the charity for the charitable term. So the charitable lead trust is basically a pure estate planning transaction, which takes advantage of all of the factors. In other words, you basically you supposedly set up a charitable lead trust, say for 20 years, pay the charity an annuity for the next 20 years, and whatever's left goes to my children. And so you beat the spread, and by beating the spread, that remainder interest that goes to the charity gets all the appreciation and value that passes to your children free of estate and gift taxes.
Okay, so Jerry, here's what I'm showing here. I'm showing somebody puts assets into a 15-year CLAT.
Oh, wait, Alan, one question.
Sure.
Why do you always want to do a charitable lead trust while you're alive for a fixed term and not for your life?
Because what's left after the fixed term goes to charity during your lifetime. I've never run the numbers on a lifetime CLAT. Can you even do?
See, the problem is if you do remember, the charitable lead, if you live longer than your life expectancy, the charity is going to get much more money. And because the tables assume you're only going to live to your life, like for example, a charitable lead trust for someone age 70 assumes the charity is going to get the income for the next 15 years. But remember, someone age 70 has a probability that they're going to live beyond the 15 years. So you're getting a charitable gift tax deduction based on the fact that charity is going to get it over 15 years. But if you live 20 years, the charity is going to get more than, and you don't. And the fact that you give more to charity is irrelevant. It's based on what the expectation is. So you don't. And also, interestingly enough, if you live too long, if you live to 100, guess what? The charity is going to get that payment for way longer than you expect.
Okay, so Jerry, what I'm showing here is a 15-year CLAT. The payments start low and they go up by 20% a year. The amount put in is $10 million. There's no gift on formation because the annuity amount is sufficient to cause the charitable payments to be worth $10 million in present values based on the IRS discount rules. The charity is going to get a total of $16,854,000, and that can be my family foundation. The remainder going to my descendants without any estate or gift tax is $4.8 million. And the income tax savings, I get a $10 million income tax deduction. If I can use it all against ordinary income, I'm going to save $3 million taxes. So this spreadsheet.
Now remember,
Go ahead,
Alan, that charitable income tax deduction of $10 million, you're assuming you're in the 37% bracket, the highest federal bracket.
right?
So that $10 million charitable deduction, if it's a grant or trust, saves you $3.7 million. But you have to report all the income the trust actually earns for the term. So the true income tax savings is really nothing more than accelerating a deduction So it's not really 3.7 million, it's something less.
Okay, so we'll fix that. But the numbers here on the spreadsheet do show a 3,000,006, I mean, a large income tax deduction, but then ordinary income. But if you fund it, Jerry, what if I fund it with stocks that don't pay any dividends, or I fund it with a low cost variable annuity contract that pays no income, and then I don't have income to the grantor unless the grantor dies during the CLAT term?
Yeah. You're getting a little bit beyond. Uh, in other words, the charitable lead annuity trust, the annuity is a fixed amount that must be paid each and every year, regardless of the income. So essentially, if the income is less than the annuity amount, you have to evade principal. If the income is greater than the annuity amount, that accumulates in the trust and takes advantage of financial leverage so that all that spread will pass to your children, who are the remainder beneficiaries, free of estate and gift taxes.
So Jerry, what CLAT term are you most often using? We're commonly using 20 years. How many years do you commonly use?
Well, here's the key. You have somebody who's 92 years old and in good health. And we know that the key to a successful estate planning is compounding all of those factors over a long period of time. Well, guess what? Someone age 92, we don't have 20 years to compound it. However, if they do a charitable lead trust for a fixed term, you get the compounding over a 20-year period. So, and the point is you want to basically look at when do the children need the extra money going to the as the remainder beneficiaries of the charitable lead trust, and that depends on what you have done with your other estate planning, the bypass trust, outright gifts, and you try to say, when will my children need access to the funds in the charitable lead trust for a fixed term? And so
Right.
It's not 20 years, it's when do you want the children to get that money after I die?
And most clients who are wealthy enough to be doing this have a 20-year runway, or the children should know they only have 20 years before. They need to make it last at least 20 years before the CLAT hopefully gives them something. So Jerry, so I showed now with a 20-year CLAT, the combined income savings and present value of the remainder to children, 9 million, present value to charity, 10 million. So you get 100% charitable deduction, but almost 50% of this ends up with your children. So Jerry, let me click one more thing here.
Wait, I want to show you something.
Okay, go ahead.
The key is, remember, it's all financial leverage. And the key is have the trust having as much principal as possible for as long a period of time. So if you have level annual payments, that means you start depleting a lot of principal in the beginning. But if you have increasing payments, the amount of principal that's depleted in the beginning years is a lot lower, so there's more principal to take advantage of the financial leverage. There's one little problem is with a 20% increasing payment, look at what the payments are, look at how they grow. Just look at the column where the payments with a 20% increasing, to zero it out, start at how much? 90, where was it actually?
99,000.
Okay.
And then they get up to 3,107,000 at the end.
All of a sudden, that could create tremendous liquidity problems for the trust because the
Right.
income is not going to be as great as the final annuity payment. So increasing it by 20%, it creates a lot of exposure at the end, which might create liquidity problems. So essentially, to reduce that liquidity crunch, I don't use 20% unless the client fully understands that there could be a liquidity problem towards the end.
Okay. So do you want me to show you a shark fin then, where you would make low payments for the charitable term and then a lot in the 19th year for charity, which we call the shark fin.
Yeah, show the shark fin and see what happens.
Okay.
In other words, in the shark fin, what happens is, well, you got the example up there, Alan?
Yeah. You want to give 1% a year for the first few years, or what? How much do you want to give?
Well, it's a fixed dollar amount. How
Okay.
much you putting in? How much are you putting into the CLAT?
10 million in the CLAT. So how about the annuity amount, 100,000 a year, or you want it lower?
Make it lower. Make it 50,000 a year.
Okay. So now we're showing 50,000 a year for 19 years, and then a final payment to charity of 21 million, and then the children get 22 million. That's pretty good. You get a full charitable.
In other words, as long as they understand the liquidity problem you could have in making that last $21 million payment in year 20, but basically that is more. In other words, for the first 19 years, you have a larger principal amount that is earning income that beats the spread. That's the key.
Right. And then Jerry, if you used an LLC, if you put the 10 million in an LLC and you transferred a 99% LLC interest into the CLAT in this situation, what kind of discount would you like to take?
Let's be conservative and take 25%.
Okay. So when I click to a 25% discount, boy, look at these numbers. These are very nice numbers. Now the CLAT is really considered to be 7,500,000 starting value. So the 50,000 a year goes to 37,500 a year. The last payment is 34 million. I'm sorry, the last payment to charity is 15 million, 16 million left for the family. So after taxes, it's much better. Well, after taxes, when you take the income tax savings of 2,700,000, so this is interesting, Jerry. I've got less tax savings because I took that discount, but still the present value of what's there for me and my children is higher, and what ends up going to charity is lower. So I find that to be very interesting. So the children are going to get about 65%, the charity about 35%. So I can go back to this module now and plug in that number of 65% or 60% and go to the testamentary charity, and that's the way it works. Now, before we do anything else, we must do the last polling question. It's 11:58. I apologize. Usually I do the last polling question at 11:50. Thanks everybody for hanging in for this. Would you like to sign up for our free Thursday report? Yes, I would like to. Is A, B, no, C, yes, because it's interesting, D, no, I'd rather water my cactus, or E, all of the above, which makes no sense at all. Josh, that's an excellent polling question. That's more confusing than the federal estate tax.
Yeah. All right. So, Alan, we have to wind this up. Here is the key. Is when you have the client come in and you start to try to explain all these different techniques and all the factors, it can be very overwhelming. And when once you get used to using something like Estate View, you can actually sit down and the client can visualize it. But more importantly, when you can change the numbers, you can actually sit down with the client and decide how to fine-tune the structure to accomplish the client's estate planning objectives and financial objectives and their personal needs as well. And so what this does is allows you to communicate what's going on in an understandable manner, but also sit with the client and design how much you're going to allocate to each technique, what techniques you're going to use, so that they can kind of design the financial commitments with you and they can understand it.
Beautiful. Okay, Jerry, let's talk. So the presentation's over. If you were on this presentation to get continuing education credit, you got it. You're not going to get more than an hour. But now we're going to, Jerry, tell us, I'd like to spend 5 or 10 minutes, if you like, or more even, talking about some of these topics and how this impacts estate planning. Because I know a lot of times, Jerry, I look at the topic and I say, there's really nothing there for me. But then the fact that you have sat down with each of these presenters and told them what they need to make sure they cover and what the practical aspects are sometimes very pleasantly surprising. So tell us about why you're excited about some of these topics and what it means.
Like, for example, when people are doing, buy-sell agreements or passing on the closely held business, in other words, a lot of estate plans, from a financial point of view, it's a family business, and you want the children to kind of inherit the family business. Okay, and if you start to just think about the estate planning, you're forgetting one important point. The family business involves succession planning, and if the children are going to be active in the family business, if all the children are going to be active in the family business, that's pretty easy. You give all the children an equal share in the family business. But what if you have 4 children? One of the children has been working in the family business, and the other 3 children have nothing to do with the family business. How do you kind of treat all the children equally when one of the children is going to be devoting full time in the family business, and the other children are just going to basically get the income from the family business? So what happens in a situation like that? The child who's devoting all of his time and effort to the family business is going to say, a lot of the family effort that I devote to the family business, my brothers and sisters are going to get a benefit for all that sweat equity I put in. So how do you design a succession plan when one child is going to work in the family business and the other children aren't going to work in the family business? How do you give the child who's going to work in the family business the benefit of their sweat equity to improve the profitability, or at the same time give the children who are passive an upside interest in the business? The same thing applies when you have key employees, and you want the key employees to have an incentive to stay on with the next generation. So Chris Jones, who happens to practice with Moore and Allen in Charlotte, North Carolina, was highly recommended to me that he takes into account all of the non-tax factors in a business succession plan. In other words, it's really not how to pass the business on saving the most estate and gift taxes. It's how to ensure the success of the business when you have active and passive children and key employees. So it's not an estate plan to save estate tax. It's how to ensure that everybody is treated fairly. Okay. Now, another factor is if you look at valuation of life insurance policies. When you have life insurance policies and you want to transfer them, how do you value them? And what's interesting is the valuation rules for life insurance policies were developed a long time ago when all you had was whole life. With all the different life insurance products today, the old rules are no longer viable, and valuing life insurance is an art form. And basically, there's a lot of myths about how to value life insurance policies. You look at the cash value in a life insurance policy, you think that's the value of it. Well, that's not entirely correct. And so our speakers are going to talk about how do you value life insurance policies? What if the life insurance is in your pension plan? What if you want to basically use the life insurance for a buy-sell agreement? What if you want to basically, you have an existing life insurance policy that has a lot of cash value and you want to gift it? And then suppose you don't need it anymore and you want to sell it. All sorts of different factors enter into how to value. You can get different values depending upon what your objective is. And again, it's not how to save estate taxes, but it's a financial analysis of how you value life insurance policies in different situations. Okay? Ooh.
Excellent.
Now,
You want to talk about? Go ahead.
Another topic that is interesting is Kim Kamen. You don't have to, if you have charitable inclinations and you want to establish a trust, you don't have to mandate that the trust must give the charity. And Kim Kamen is going to talk about how to design trusts that can make the decisions on a yearly basis after you're gone of how to give the charity without having a requirement that it must be a charitable annuity or it must be a charitable remainder interest. Again, a very practical topic. And then on where's Brad Dillon?
Is he on Friday?
I think, yeah, look at Brad Dillon on Friday.
Yep.
And
Right
what
there.
is his topic?
Communicating estate planning proposals using financial modeling.
So what do you think he's going to be doing, Alan?
I hope he's going to be doing what we were just doing, only maybe a little better.
Exactly. Okay. Now, there's one other factor which is very interesting, is the burn caused by grantor trust status can be very significant. And when you do the financial modeling and you say you start somebody with 40 million and you see that age 85, all that's left in your name is $10 million and you're going to live another several years, you say enough is enough. How do I turn off grantor trust status or mitigate the burn? And one of the things that Brad Dillon is going to do is what things you can do to reduce the impact of the grantor having to pay income taxes. And he talks about a lot of practical things that you can do. Again, now, another thing is, if you look at Stephen Liss, and a lot of times, who can be a trustee? And there's a lot of confusion as to who can be a trustee. For example, husband creates a trust for the benefit of my descendants only. Can the husband be a co-trustee to manage only the investments of the trust without estate tax exposure? Yes. However, the husband doesn't want an independent trustee or a bank to be trustee. It's It's a trust for the benefit of my descendants. So can the husband's spouse be a co-trustee of that trust if the spouse is not a beneficiary? And the answer is yes. So Stephen Liss is going to talk about who can be a trustee and under what circumstances the settlor and the beneficiaries or other family members can be trustees of a trust and talk about. With that, and by the way, basically, the football game on Saturday is Ohio State. And Alan, do you know my favorite college football team is?
Michigan.
Right. No, it's whoever's. I went to the University of Michigan, so my favorite college football team is whoever's playing Ohio State.
You know, Jerry, I think tell us about the Thursday night reception. Is that still at the Studebaker House?
Oh yeah. We Notre Dame doesn't have any, all the sponsors with fancy dinners and lunch, and we have a nice reception on Thursday night for all the participants with a nice buffet.
And do you have lunch speakers also lined up for this year?
No, because the lunch speakers, it's too noisy at lunch, and people want to talk and chatter, so we're not going to have any lunch speakers.
But you do have seated round tables with free lunch, because I've learned a lot.
Yeah, everybody sits in one big room and has lunch with everybody there. So there's no sponsors. We give everybody lunch.
Yeah, and that's a great thing. And something I'll mention is if you've gone to Heckerling, you've gone to NYU, you've gone to a lot of these conferences, the Notre Dame conference is very friendly. The speakers are mixing it up. The people with a nice Midwestern attitude. So you can learn just as much between sessions as you can at the sessions. The other thing I really like about Notre Dame, very smart, full 60 minutes for each session. As a speaker, I can tell you, I can cover probably 30% more material with that last 10 minutes, because it sometimes takes 50 minutes to lay the subject down. All right, Jerry, let me just see Jerry, if you need to run, you can run, but let me just see if we have any questions. I like to try to answer questions. Okay,
no, I'm glad. I'll answer questions, Alan.
Okay, great. Would you be able to send us the link to the estate view in the spreadsheet? Yes, Josh will do that. But just remember, just go to estateview.link, L-I-N-K, put in your email address, TEST@TEST, no caps, and then password TEST, and we welcome all of your comments. Okay, Jerry, this question is, the person says, I form a CLAT, I make it what's called a grantor CLAT so I can get my income tax deduction, and then the CLAT has stock that goes up in value. The CLAT gives that stock to the charity to satisfy its annual payment requirements. Does the payment of the appreciated stock to the charity cause an income tax event?
Absolutely. In other words, the charitable annuity is a fixed amount. Say it's $100,000, and the trust has an obligation to pay the charity $100,000 each and every year. The trust has an asset with a basis of $30,000 that's worth $100,000. So the trust is satisfying its obligation with an appreciated asset, and therefore satisfying a $100,000 obligation with an asset worth $100 and a basis of $30 means the trust has realized a $70,000 long-term capital gain. And if it's a grantor CLAT, you as the grantor have to report that $70,000 gain. The concept is the trust has a fixed dollar obligation, and it's using an appreciated asset to satisfy its obligation. That's an income tax realization event.
Okay, good. The next question is, the user says, I noticed that Estate View always is keyed in so that the seed capital gift before a sale is 10% of the sale amount. Is the 10% set in stone, or where does that come from?
You mean the 10% minimum funding myth?
Yeah, the myth. Where does that rule come from, right?
In one of the private letter rulings that Burl Abbott did, the IRS has said, what happens if the trust doesn't have enough money? So Burl said, well, they'll run out of money, just like a grap. So the IRS said, well, we'd like to have the trust have some skin in the game. How about if it puts in 10% as a gift and trust? And Burl said, fine. And that all of a sudden people said, oh, it must have minimum funding. The answer is no. Basically, if you look at all the income tax reality of sale cases, they will respect the sale if you can show, based on all the facts and circumstances, the trust will be able to meet its financial obligations in an understandable manner. And you can show that if the income, remember the spread with the discount and the financial leverage. So basically, in that situation, if the trust, if you can show that the trust can make all of the payments just on the income from the property, that means that you've met the reality of sale test. In the income tax area, you have a litany of guidance and revenue procedures and case law that have respected related party sales if you can show, based on all the facts and circumstances, that the trust can meet its obligations in the future in a timely manner as they become due. And here's a very famous income tax case. Actually, it was basically Junior goes to the bank and has no assets and wants to borrow $1 million for a startup business. And the bank is going to say to Junior, you little pisher, you don't have anything. We're not going to lend you the money. So Junior comes back with his father, who guarantees the loan, and the bank will make the loan. So you don't have to have minimum funding. You basically can have the beneficiaries of the trust who are going to get the benefits of the trust make the guarantees. So you don't need a minimum funding.
So Jerry, as you know, there's this concept of the beat it. One of the attendees is saying, can I have my father put $5,000 in a trust for the client? The client is the trustee and beneficiary, can only receive what he needs for health, education, maintenance, and support. And then the client would sell assets to the trust in exchange for a note. Would this be possible? Would this be feasible for, say, a $10 million note? You only have $5,000 of seed capital.
Yeah, that's why we use beneficiary guarantees. As a matter of fact, Dick Ocean's associate, Heidi Friedman, that the trust has $5,000 and then is going to issue a $10 million promissory note. So basically, there was another trust that had $5 million of assets in it. So that other trust guaranteed the BDIT's promissory note. And the other trust basically said, we're not going to make any distributions that will reduce the trust assets below the amount we're responsible for in the guarantee. So that's the way you do it, is you have guarantees to guarantee notes. And in the real world, if you don't have enough money and you get your father or parents to guarantee your note, the bank will lend you the money. So why can't we do that in the estate planning world as well? Okay. Interestingly enough, Dick Ocean's had me write an article on the minimum 10% funding myth, and also write another article on the BDITs. So if anybody would like those articles, just email me, and I'll send you the articles that Dick Ocean's had me write.
So Jerry, how do you make sure that the beneficiary of the BDIT is not selling the $10 million worth of assets at less than fair market value? Because if he's made a $5,000 indirect gift to the trust, then half the trust will be subject to estate tax.
No,
How
what,
do you,
no, no, what happens is the child wants to be a beneficiary of a grant or trust. So the child's parent makes the $5,000 gift, and the parent says, the trust is $5,000 gift, and the beneficiary of the trust is my child and my child's descendants. And it's a grant or a trust because of the $5,000 lapse rule only applies for gift and estate tax purposes and not for income tax purposes. So in that situation, you basically, you don't have to worry if you can show that the trust will have access to the money either through the income from the income producing asset that the trust purchased or for beneficiary guarantees, that should suffice.
all right, so I'm just going to remind the audience here next week, Florida's first female-owned trust company and how to handle clients when they talk about trustees and trust companies. September 2nd, Jerry rejoins me for using private annuities and self-canceling installment notes. Jerry, do you want us to expand that to 90 minutes or 2 hours? What do you prefer for that?
Well, here's the key is we're going to recommend private annuities and self-canceling installment notes for healthy individuals who we expect to live a long period of time.
Right.
So if you want to expand it to 90 minutes, we don't have to rush through the stuff as quickly.
Okay, so Josh, I think that's what we'll do. Then Ed Gordon is going to join me September 9th, and Jerry, you're welcome to join us. He has a wonderful presentation called Life Insurance, the Good, the Bad, and the Ugly. He's very knowledgeable. And then Saturday the 30th, Ed Gordon is going to lead me in a presentation that he calls Planning Techniques, the Good, the Bad, and the Ugly. And Jerry, you're welcome to join, and we can expand these. So thank you very much, everyone who attended this program. If you're still out there, you're wearing your helmet, and you're loyal to the estate tax world, send us your emails so that we can improve our materials and have a great rest of your weekend. Jerry, any final words here?
No, the point is we have a state view, and if you have trouble figuring it out, get your grandchildren to help you figure it out.
Right.
But once you get comfortable with it, it becomes a wonderful tool to illustrate and custom design the techniques.
And Jerry, you never have to ask me about whether we can give a state view to students. It will always be free of charge to any student enrolled in an undergraduate, law school, or Masters of Law program. No doubt about it. That'll be perpetual. And thank you so much for all of your leadership and guidance with respect to that and everything else you've done for us and everything you've done for the profession. It's just amazing.
Thank you, Alan.
All right, we're calling it a day. Thank you very much.